have the new glasses, by the way? You look like you like a pilot.
Hello, everyone, and welcome to another Finimize Analyst Monthly Roundup, where we are going to go over our latest research pieces for February, give a quick update on our latest performance stats, and then perhaps most importantly, go over all the questions we received from the community. So thank you to everyone who put forward their questions. So that's the agenda, and then without further ado, let's get started. And I'm joined by Finimize analysts Russell and Theodora, who and all of us collectively are going to be answering your questions. So in terms of this month's research, I put out an update on solar foods, and I'm going to touch on that in a second. Russell initiated a new idea on the London Stock Exchange, and Theodora initiated a new idea on Rolls-Royce. So, a big, nice variety of ideas for you there. So mine is, this food tech company trying to create a new protein out of thin air. London Stock Exchange, everyone knows what that is, and then Rolls-Royce, right? So your engine maker, but now increasingly becoming an AI power play, and Theodora is going to dig into that. So very quickly on Solar Foods. So in case you're not familiar, just a very quick recap about the company. Solar Foods is creating a brand new protein, built as from thin air, but it's not entirely from thin air. Basically, they use water and carbon dioxide pulled from the air, some nutrients and so on. And they cultivate all of that with a natural microbe in this big bioreactor, in this fermentation process. And you basically get soline, which is a protein that combines the best properties of plant and animal-based proteins, but without their key drawbacks. Now, the reason I, ran through the numbers again and did an update on the stock, and more importantly, an update on the financial model and valuation, is because over the past few months, two key updates happened. First of all, the company announced a strategic pivot around Factory 2, which is their first large-scale production facility. So at the moment, they have a demo, small-scale demo facility, but Factory 2 is really where things go, from the lab to proper scale and selling, soline in bulk. And the pivot that they did was essentially, instead of trying to build everything themselves, which would require a lot of financing from an equity and a debt perspective, what they did is basically get strategic partners on board. So basically, you're going to have the strategic partners, and they announced who it is. It's going to be this very, very big engineering firm that deals a lot with food companies that's going to put in their own money and build, the bulk of Factory 2. In exchange, it'll get tolling income for things like utilities, electricity, and so on and so on. So they will not get ownership of Factory 2, but they'll get compensated for putting in their money. And basically what this means for Solar Foods is that it significantly reduces the upfront financing required to get Factory 2 up and running. It de-risks the whole thing, both the current build and then future builds, essentially, by bringing these strategic partners on board. Now, of course, it does give up some margin by doing that because you have to pay these strategic partners, so it reduces their margins. But on the flip side, it boosts the firm's return on invested capital, and it makes it, a more capital-light business, allows it to focus on its core strength, which is this, gas fermentation technology and creating soline, essentially. So that was quite important. Obviously, that required a big update to the financial model because the financing assumptions, changed. Obviously, the margin assumptions changed and all that. Second of all, and related to this, in light of this, pivot and now requiring way less equity, actually last month, they got that equity raise out of the way. So they successfully raised 25 million euros. And a big chunk of that went to the strategic partner, like once again, this really big food engineering firm. And they got that financing risk done and out of the way. So that was something really positive. And when I first wrote about this company last year, I actually recommended that you only put half of your intended money into the position and wait for the equity raise, which I anticipated to happen this year, to move to a full position. Because naturally, when you have an equity raise, the stock price goes down to factor in the dilution. And that's exactly what we saw. So after they did the equity raise, I now recommend moving to a full position in the stock because we have that big risk out of the way. In my updated financial model and valuation, I see roughly around 200% potential upside. Yes, that sounds like a lot because, ultimately this is a high risk and high potential reward stock, right? It's creating something very novel. And just because it's creating something that sounds good on paper, we still have to clear the biggest hurdle, which is, in my opinion, consumer acceptance, right? Think about Beyond Meat. They had a great product on paper. Okay, let's, hey, shift meat eaters to eating plant-based meat and give them something that tastes and smells like meat. Sure, but consumers ended up rejecting that product for various reasons, and the stock has done really poorly. So we need to make sure Solar Foods will not be in a similar position and people accept this novel protein. And once that happens, then the story will be even more de-risked. So the reason I say all of that is, yes, I see a lot of upside in the stock, but it is still a very risky stock nonetheless. And that means it only deserves a small, tiny, position in your portfolio if you do invest in it. So with that out of the way, I will hand over to Russell, who is going to shift from, protein from thin air to something a lot more tangible, London Stock Exchange. The floor is all yours, Russell.
Hey, thanks, Reda. So the London Stock Exchange, or as they like to be called, LSEG, is actually kind of become not just a traditional exchange, it's become like a data and analytics powerhouse. It bought a company called Refinitiv a few years back, and that's kind of means that its data and services business is about 40% of its revenues. And aside from that, the markets division, which is its trading in stocks, derivatives, FX, that kind of accounts for around 20% of revenues, and a little bit more than 10% from the FTSE Russell, which is like the ETF related business and an index provider. And they also have a post-trade and analytics service. So the LSE group is actually a very diverse business overall. That's kind of left it a little bit vulnerable to the AI threat. And that's been one of the main reasons why the stock's fallen 35% over the past year and 14% year to date. But that's brought its valuation down to 10-year lows. And that looks a bit cheap. And you can see on the chart that LSE Group and the two other big European exchanges, Deutsche Börse and Euronext, have all been hit hard over the past year or so. And their valuations have come down. You can see that LSEG 1 year forward PE now trading around 16 times. And as I said, that's like a 10-year low. And that looks too cheap. Now, for sure, its data and services business is to some extent vulnerable to AI. But the company's made a strong case to explain why a lot of it is going to be AI proof. It's proprietary data. Their workflows are highly embedded into trader workstations. It's not easy that AI is going to replace it. It's not to say that it's 100% sort of immune. It did show that 10% of its data could be vulnerable, but still the sell-off looks vulnerable. And if you look at that Euronext share price or valuation that's come down to, Euronext is basically a traditional kind of a exchange. It doesn't have any of that data and analytics, and that company too has been hit hard. Now it could be because Deutsche Börse and LSEG have been hit and it kind of moves in sympathy, but it could just be because there's so many funds that could be allocated in theory to financials, and European banks have been much more attractive over the last couple of years. We've seen those big cuts in interest rates by the ECB. We've had cheaper valuations, stronger profit growth. And net, investors have favoured investing in European banks over exchanges. So that could be one reason why, these LSEG groups has been hit so hard. Anyway, that's a potential reason why. But what's interesting now is activist investor Elliott has taken a stake. It doesn't look like it's 3% because it wasn't declared officially. It was leaked to the FT. But still, they're asking for a sizable 5 billion sterling buyback and for some potential strategic change. So its full year results are due to be announced tomorrow, Thursday. And I'm watching closely to see what type of buyback could be announced or maybe strategic, and also progress on how it's trying to AI proof its business. It looks quite cheap here and it could be an interesting opportunity. So that's why I kind of added it to the Finimize portfolio.
Fascinating, really, really interesting. And then last but not least, Theodora with Royce.
Yeah, thanks, Reda. So, Russell, I like this thing we have going between us about choosing English companies this month. I think I very deliberately wanted to look outside the US, and Rolls-Royce, as I was digging into the companies, actually stood out to me. And so I think it's really interesting, right? Because when you think of the name Rolls-Royce, most often people outside of the investing space will think of luxury English cars. You're not wrong to think about that, but that part of the business, that brand was actually acquired by BMW some time ago. So the Rolls-Royce I'm talking about is actually a company that is in the aerospace world. So what they do is half of their business, they build jet engines for large commercial aircraft. So if you're taking a flight from New York to Sydney on an Airbus A350, it's very likely that the engines that power the aircraft is made by Rolls-Royce. And then the other quarter of their business is in defense. So very high-tech stuff. They do nuclear propulsion systems for submarines. They're quite big in submarines. And then the other quarter, which is really interesting, is in power systems and critical infrastructure for things like data centers and things like that. So the way their business model works is actually really interesting. So if you think about a jet engine they sell, you would think that the technology in there is so good that you're just gonna cost a fortune to sell it. But the fact is that Rolls-Royce actually makes very, very, very low margins on the jet engine, where the biggest part of their business comes in is in servicing the engines, right? So they're not earning money upfront by selling the engines. What they do is that, they earn money every time the engine flies. So airlines would actually have to pay Rolls-Royce based on flying hours for maintenance and servicing. So if you've got more planes in the air, more flying hours, the more recurring revenue Rolls-Royce generates. So the tricky thing is that flying hours is super important. And if you think back in the last 5 years, what happened? Right, COVID happened. So nobody was flying anywhere. So after COVID actually grounded flights globally, those revenues collapsed. And you can imagine, if you look at the chart of Rolls-Royce share price between 2019 to 2022, it was disastrous, right? It went down all the way down to like 40p. But the difference now is that you've got global flight hours recovering very strongly, and that recovery is flowing straight into cash generation. So now the stock has actually gone up dramatically. And, as an investor, I'm looking at it and I'm naturally thinking, is this done? Has it run its cost? It's what you would call a 10 bagger from its lows. So the obvious question for me, and I guess for you guys, is, has the opportunity passed? In my job, I actually say, I don't think so. Sure, the stock is not cheap, but I detail the reasons why. So first, I think that management has fundamentally transformed the company. So they've cut costs very aggressively to beef up the balance sheet. They have streamlined and simplified the operations, and this has helped improve the margins on an underlying basis. And the balance sheet as well is so much stronger. So this is not the same business that we were talking about 5 years ago. They have renegotiated contracts. So now each of the contract they have is so much more lucrative. It's a company that's leaner, it's more focused, it's far more disciplined. And then the second thing I think is that Rolls-Royce has two powerful growth engines beyond purely aerospace. So we know defense is super interesting based on what's going on in the world right now. Lots of countries in Europe especially have pledged to kind of increase their defense spending to not just hit the 2% target and then longer term hit the 5% target of GDP. So defense is a strong growth driver for them. And Rolls-Royce is a key supplier of engines for military aircraft and naval propulsion systems, as I mentioned. So that spending is structural, it's not cyclical, it's not going to go away in the next 10 years. And then the other thing I would say as well is power systems. So they own the MTU brand, and that brand is involved with supplying backup power to data centers and industrial facilities. We know that power constraints are a big factor in data centers. You want reliability of supply, so having backup power is super important. So with AI and cloud infrastructure exploding, you need reliable power, right? You can't get around it. If you have a data center you've spent billions on it, you cannot afford downtime. And so that, again, is a long-term tailwind for Rolls-Royce, which I think the street is underestimating, right? Because people who are covering Rolls-Royce are aerospace analysts, and what really do they know about AI data centers? And then lastly, there is this opportunity which I find it's really interesting. I haven't modeled it in my valuation, but it's definitely kind of upside to my Rolls-Royce case. And that is SMRs, also short for small modular nuclear reactors. So Rolls-Royce, actually Reda has actually written a lot about it, so probably worth reading his drop. And so Rolls-Royce is developing these as a potential future energy solution. So the first SMR is not expected to come in this decade, right? So, I'm not baking that in, but it's interesting that, if the first contracts are signed, you don't wait until SMR starts up before you give it value. Actually, any contract that you sign, any proof that the money is going to materialize, that can unlock meaningful upside for the company. So just to sum it up, I think my investment case for Rolls-Royce is really a company that's generating increasing cash flow. Between now and 2028, I estimate on my numbers 15 billion pounds in cash flow. You've got margins improving, you've got very structural exposure to key growth trends like defense, like AI-driven power demand, and then long-term energy optionality. Nuclear is super interesting. Yes, the elephant in the room is that it does look more expensive than it did 2 years ago, but the business quality is also significantly higher. So the question isn't, is it cheap relative to its crisis lows? I think the question is whether the market is actually properly pricing the durability of its cash flows and its future growth opportunities. So there you have it.
Yeah, really fascinating. And you're right, I have written about SMRs. I think it's a very interesting opportunity for data centers, because now if you think about it, the big bottleneck with data centers, well, there are several bottlenecks, but one of them is memory chips, which I know Russell has written a lot about, and it's like the core thesis for him being optimistic about South Korean stocks and memory makers over there. But another huge bottleneck is energy, right? And I think what's super fascinating about SMRs is that they kill two birds with one stone. Data centers are increasingly being told to basically bring their own electricity with them, because you're getting pushback by consumers who are facing higher electricity rates by their utilities, because a lot of data centers are sucking up demand in their service areas. So now data centers are increasingly being told, hey, you want to build a data center, you need to procure your own power. So the beauty about SMRs is that, to your point, small modular reactors, they can be co-located with a data center, which is really, really beneficial. And then second of all, a lot of these hyperscalers, like to at least flag or wave their green credentials, something they're potentially failing on right now because they're, putting natural gas turbines hand in hand with their data centers. But of course, SMRs would also help solve that, because nuclear, no carbon emissions, and so on over while they operate. So very fascinating theme. It is long dated, but it's something definitely worth watching. So thank you so much, Theodora. Right, cool. Now, before we move on to community questions, just a very quick performance update. So as of the 21st of February, so we update these every week, and be sure to bookmark that sheet that we share with all of you if you want to see these stats updated weekly. So over there we show all the underlying ideas we have there, linked to the relevant piece, the benchmarks, and then performance and relative performance. But looking on average over all our ideas, and this includes the ones that did well and the ones that didn't do well, so we're not cherry picking over here. So basically our average absolute return on an annualized basis of all our ideas currently sits at 40%, so that's really good. And on a relative basis, so relative to benchmarks, also annualized, we're looking at 18%. So very, very proud of that performance. So Russell, Theodora, well done, and let's keep it up. The short answer is that, it doesn't really impact, because these portfolios were specifically built for this. So my key philosophy is that, as investors, we cannot really predict the future. And I think it's very important that people own up to this. You have a lot of people that put forecasts out there. Oh, the S&P 500 is going to end 2026 at this level. Gold is going to do this, and so on. Honestly, I wouldn't listen to anyone who thinks they can predict. I can't predict. No one can really predict the future. And I think your job as an investor is to be honest with yourself and admit that you cannot predict the future. And then in light of that, what you should be doing is to build a resilient portfolio that can withstand any different future, any potential future. Okay. And that's exactly what these portfolios are built for. So, you referenced the all-weather portfolio. This is exactly what Ray Dalio wanted to create when he did the all-weather portfolio. And actually the reason it's called the all-weather portfolio is that it can withstand any weather or any season. And specifically, he's referring to, economic seasons, things like rising economic growth, falling economic growth, rising inflation, falling inflation. And he set out to put together a portfolio that can withstand all these, different economic seasons, essentially. So all these things you're referencing, changing geopolitical order, trade relations, it doesn't really impact the assumptions that went into these portfolios because these portfolios are really built for this specific purpose. They include asset classes that do well, whether geopolitical tensions are rising. So, all-weather portfolio and the Easy Rider both include gold, for example, and gold is an obvious hedge when geopolitical tensions are increasing. So all these portfolios have this nice mix of asset classes that aim to kind of neutralize the impact of all these kind of different moving parts. And if you are following one of these portfolios, honestly, the trick is to just stick to it as opposed to trying to change it up based on what you think the future will hold. It's also worth mentioning that don't forget, in my version of the all-weather portfolio, the one that I've put out as part of Finimize, it's a trend filtered all-weather portfolio. So it holds the same asset classes as the standard all-weather portfolio, but it applies a trend filter on each of the asset classes. What that means is if a particular asset class is not doing well because of the changing world order, or let's say higher inflation, therefore bonds are doing poorly. Well, what the trend filter aims to do essentially is to step out of that asset class that's trending down and move into cash as a defense mechanism. And then once the trend reverses and that asset class is starting to trend up, it moves you out of cash and back into that asset class. So by doing that, it actually factors in these changes, these big geopolitical, trade, macroeconomic changes you're referring to, by trying to capture asset classes that are doing well, are in an uptrend, and then sidestepping the ones that are in a downtrend. The Easy Rider doesn't do that. It's a buy and hold. But one other version of it that we have, which is the Momentum Rider, basically takes the same asset classes as Easy Rider and applies a momentum filter, or should I say a trend filter, on them. So overall, doesn't really impact. And the key to good investing, in my opinion, is to have a sensible portfolio, sensible strategy, and to stick to it. And often sticking to it is the harder part for people because, emotional things and behavioral biases kind of kick in. But, these are sensible portfolios. And if you are following them, I do recommend just sticking to them.
Okay, so an update on Indra Sistemas. So just for those who aren't aware of what Indra Sistemas does, is they are a Spanish aerospace and defense technology company. They built radar systems, electronic warfare capabilities. They also do air traffic control platforms. Seem rather random, but they actually started off from that. And they also do mission critical command systems for governments and militaries. So the thesis, when I wrote about this a couple of months ago, was that for years, investors, the market was viewing this company as a hybrid, kind of part low margin IT services company, and also a part defense contractor. And so the market valued it accordingly. And also, this company wasn't covered by defense analysts in your investment banks. They were covered by your tech analyst, and this would rank really low compared to your Mac 7 of the world. So my thesis was that Indra is transitioning into a far more defense-focused, higher margin business at exactly the time when Europe is structurally increasing their military spending. So what that would mean is that margins will expand, you have greater backlog visibility because defense contracts tend to be super long-term, and the company would increasingly be treated as a serious European defense player. The stock's done really well. In the last 6 months, it's actually up 50%. So I recently wrote a piece as well saying why I don't think the re-rating is finished. I think the stock has done well for good reason. And that's because earnings have kept up and people can see the transformation of the business. Now, the question posed is that the stock, you've bought into Indra Sistemas, it hasn't done well in February. And I think it's for good reason. If you're buying into a stock that's done really well in the very short term, there is naturally going to be lots of volatility. The story hasn't changed. I actually see more upside to the company. But the path there is just going, you have to accept that if you're buying a stock like that, the path there is just going to be really bumpy. So you have to accept that it's kind of buy and hold. You're not buying for the short term, you're buying for the really long term because, since I wrote about the stock, the company has actually locked in a record kind of 9.5 billion euros in backlog, right? And that's going to take years for them to kind of, for it to materialize in the top line. They've also won a landmark, 300 plus million contract in the US. They've delivered 50% year-on-year earnings growth. Margins are still expanding as defense and air traffic system takes a bigger share of the mix. So I think it's still trading on 10.5 times forward EV EBITDA. That's how I used to value the company. I'm pretty conservative. I give it 12 times. And that's already well below what defense peers are trading at 15 times. And I think the road to them actually hitting a higher multiple, say my 12 times or peer average of 15 times, is if they can spin out their IT services company, that's optionality, or if there is further consolidation in the space. So they can acquire more defense companies, bulk up the defense bit of their portfolio. And on that case, I'm actually still pretty excited about the company over the next 6 to 12 months.
Thanks, Daisuke. So it's an interesting question. It's one that I and I'm sure Theodora and Reda think about all the time, or at least a large part of it. So yeah, the rotation's been quite severe so far this year, at least underperformance of the tech sectors, down 2.5%, lagging the broader market, and obviously leading sectors like energy and materials. You have to remember though that in 24 and 25, tech was the leading sector in both years. And we're only 2 months into the year. So although it looks like this is the new trend and what's happening, we're not really sure how it's going to play. I think what's notable though is most active fund managers seem to want this to continue. Goldman Sachs said recently that 57% of large cap mutual fund managers are actually outperforming their benchmarks so far this year. That's the highest share since 2007. You see typically only around 20% of active managers actually outperform the market. And that's because they're underweight tech. So the good news is for them that the market's broadening out, the market's moving away from what was expensive tech into cheaper sectors, and they're positioned for that. Whether that means it's going to continue or not, we're not really sure. And I don't know. But broadening out of the economy to see other sectors benefit and see better earnings growth, that's a good thing for the economy and markets, which is why from a big picture thing, maybe the equal weight S&P over the S&P 500 pure, which has that heavy tech weighting, could be sensible. The reasons are fairly obvious. Big tech's gone from being capital light, high return business models to this heavy capex on AI. And no one's really sure whether it's going to be successful. And more importantly, if it is successful, and I'm an AI bull, I think it will be, how long will it take for those returns to show up for investors to start to have belief again? So when you look now at valuations, the tech sector's underperformance, it's now trading around 24 times price earnings ratio 1 year forward. That's near 3-year lows, but it's still more expensive than most other sectors. Industrials, 27 times. A lot of those companies are winners from the AI capex spend, so it's slightly different. Consumer staples doing well, 21 times. Financials down at 15. So it's a mixed bag. Tech still looks relatively expensive, but it does still have earnings growth kind of as the supporting factor. One area that looks AI proof is staples. They have got higher multiples, but whatever happens with AI in terms of disruption, they're not going to be able to start to create food, soaps, shampoos, whatever it is. So looking for diversity out there, the staples sector, it trades a little bit expensive, but at least it's safe. And I don't think no one really knows how this rotations will happen in the future. So we're just going to have to wait and see. My gut instinct is, because you asked about gut, is I don't think the leaders of these biggest companies in the world are all piling in with hundreds of billions of dollars if they think it's going to be a fad and failure. So my guess is it's going to work. I think keeping some tech exposure seems to be sensible, but broadening out that, diversifying your risk seems sensible too.
So ultimately, whether you should increase or decrease really depends on the overall makeup of your portfolio, which I don't know. But perhaps let me just try to answer that by, highlighting the pros and cons of investing in small caps. So first of all, why invest in small caps, or one of the reasons why small caps do well, is they are much more domestically focused, right? If you think about a large cap company, it's a multinational company, probably get a substantial portion of its earnings abroad, but small caps are more domestically focused. So really you're trying to make a bet on, a stronger US economy relative to the rest of the world, which is probably not necessarily the case today, okay? Probably was a few years ago, but if I look now overall at economic growth, some, pockets outside of the US are also quite strong. Second of all, they have, higher interest rate sensitivity. So a lot of these small caps, borrow heavily, have floating rate debt and so on. So if the Fed continues to cut interest rates, then these small cap companies tend to benefit disproportionately. Valuations are also important. So they're currently trading at a valuation relative to their large cap peers. And of course, one also, valid reason is basically to address large cap concentrations. If you look at the S&P 500, a huge chunk of it right now is concentrated in just a handful of tech companies. That's not the case if you look at a small cap index. Now, what are the issues, right? First of all, I don't know if you know the statistic, but around 40% of the companies in the Russell 2000, so that's 2000 small cap companies, are currently unprofitable. So small cap companies, don't mistake them for, high quality companies. Perhaps they have higher growth prospects, but on a quality perspective, like I said, almost half of them are unprofitable at the moment. They're quite vulnerable to leverage. So if interest rates remain higher for longer, let's say, for example, inflation proves to be more sticky, the Fed keeps interest rates higher for longer, what I discussed previously in terms of their rate sensitivity, well, that will be a hit to them, right? Because it will hurt them from a debt perspective. And that's not good for a lot of these, zombie companies that you mentioned that, basically are surviving or have survived historically on cheap debt. But, if interest rates stay higher for longer and they have to roll over or refinance that debt at much higher interest rates, well, you're going to go from a living zombie to a dead zombie, if that's even a thing. Of course, they're more volatile. Small caps are more volatile, so they're riskier. And, like I said, indices like the Russell 2000 are not quality screens. So a big chunk of them are unprofitable at the moment. Looking at your allocation, it really comes down to what you believe. If you think, the US economic growth will be strong, will outperform the rest of the world. If you think the Fed is going to continue cutting interest rates, if you think credit conditions are going to improve, and if you think that, it's long overdue that market leadership will shift away from these big tech magnificent seven companies to a much broader range of companies, then that makes sense, okay? But of course, if you don't believe these things, that might not make sense. I think a smarter thing to do, and I think if you are invested in, let's say, S&P 500 ETF, I think it is a smart strategy to address that concentration risk and look at a broader set of companies, and small caps do help you do that. And I think personally, the way I would approach it is to, instead of buying, an index or an ETF that tracks the Russell 2000, I would try to find ETFs that track small caps, but with a quality screen. So basically high quality small cap companies. So let's say one that tracks, Russell 2000 companies, but it automatically excludes unprofitable companies, for example. So I think that would be a much better way of doing it. And you can do that. I don't have specific names, but I'm pretty sure you have a bunch of ETFs that do that. So basically ETFs that screen for small cap quality, or do a profitability tilt and so on. So yeah, that's my 2 cents on that.
So yeah, we combine these questions because they're kind of there's overlap between all of them, because it's not surprising. Everyone wants to kind of think about where to invest, what to invest in, what's sensible and what isn't. So I think first start to think about valuations across all stock markets are high relative to the last 20 years. This isn't just a US phenomena, but if you look at 12-month forward PEs, even US ex big tech at 19 times, Japan's up at 18 times now. This used to be a value market. Europe sits at just above 15, Asia Pac 15, and EM sitting at 14 too. And that's high across the board. So valuations for stock markets are looking expensive across the board. Now, that's not necessarily something to be ringing alarm bells, but it's definitely a touch concerning. The reality is earnings growth is okay. And I think one of the other issues out there in the world is like post global financial crisis, but more recently the pandemic, central banks pump loads of money into the system. So asset prices of all varieties gone up. You've seen gold hit $5,000 recently. You've seen housing go up in most countries too. You've had to have real assets to protect you from that money printing. And I think to some extent, the equity market rally is part of that kind of hedging out into real assets, or, money has to flow somewhere. So high valuations are concerning, but they'll be much more concerning if we ever see a recession, earnings growth turns negative, because from up here, it could turn negative. And again, if AI capex sort of slows, or the AI turns out to be a bubble, then those AI have been a driver of so many country stock returns. So that's definitely going to be a risk. So talking about portfolios and sort of what to think about, Reda mentioned earlier, we've got the Easy Rider portfolio which diversifies across assets. You've got momentum for sectors. Momentum Rider adapts to real-time shifting trends. You've got the sector momentum edge. All of these are a good way for a starting point for a core portfolio. And then they all use around 7 or ETFs. So depending on how active you want to be or not, they're a great place to start for everybody. And then depending on your risk appetite for single stocks, whether that's small caps, large caps, or different sectors, depending, you can use that for your satellite portfolios. So again, we've got the Finimize Portfolio where all of us analysts sort of highlight the companies or sectors or themes that we think look most attractive for like this year and next. So personally for me right now, I've got a career ETF for country and AI memory exposure, because I quite like that. What's happening with SK Hynix and Samsung benefiting from the memory demand. And there's also a humanoid ETF, and this sort of physical AI robotics looks really quite interesting to me as well. So those are two of the ETF sector areas or themes that I like. So Reda, Theodora, what about you?
So in terms of sectors, I've written about nuclear and I've written about utilities. Of the two, nuclear has already had a really good run. I'm still optimistic on nuclear, but it's already had a really good run. But utilities, I'm quite optimistic about. And actually, year to date, we've already seen the utility sector doing really well as people gravitate away from, capital light software companies to, capital heavy companies that have, actual hard assets. And in utilities case, they have a monopoly actually in their service areas. So way more defensible, from AI disruption. Actually, on the flip side, they're huge beneficiaries from AI because they're the ones providing the power necessary for AI. So I really like utilities. In terms of other trades and ideas, or should I say topics? So obviously I touched on solar foods. And, if I think from an absolute return perspective, obviously solar foods looks very attractive. Like I said, potentially 200% upside. Maybe not a 2026 idea per se, because it could take a bit of time as they build out factory 2 and so on. But if you really have, a long-term investment horizon, then solar foods to me looks very attractive. Then on a relative basis, and if you wanted, a little cheeky AI hedge, essentially, is TJX companies. So a company I mentioned during the last monthly roundup. So TJX companies is, an anti-tech stock, if you will. Like everything they do is refreshingly analog. It's all about the treasure hunt experience. They're an off-price retailer, and it's all about the treasure hunt experience. So e-com sales are just like 2% of their total sales or something like that. And it's all about, people going into their stores and looking for bargains. So what TJX companies does is basically they swoop up excess inventory from other retailers. at a very cheap price, and then they sell it to customers in their store at discounted prices, essentially. And if you look historically, and I made parallels with how the stock performed during the dot-com bubble burst or the global financial crisis, it outperformed massively. So if you are worried about AI bubble and AI stocks potentially correcting heavily, I think TJX companies on a relative basis, so relative to the market, could be a really interesting opportunity.
I think for me, looking at the next couple of months, my strategy is to have some cash on the side, just because when the market is so volatile, Bitcoin, down 40%, so different sectors just getting sold off, it's like a trend, right? Software sector, and then after that, it's like financial services and so on and so forth. My kind of brain like immediately starts lighting up. It's like, oh, is there an opportunity in there? I need time to investigate, but I want to have cash on the side so that I can invest when there is an interesting opportunity. And what I do sometimes, if I don't want to just have the cash sitting around, is I invest in this JP Morgan equity ETF called JEPI, and it gives me an 8% yield. I've written on it before, like call ETFs, call option ETFs, and they give you an income from that. But that's one way I kind of position my portfolio. The other way I do is I like to load up on high quality names, compounders. So I'm a fan of long-term quality compounders. They're not cheap, but they give me security in my portfolio. So the likes of Costco or GTT, which is also in our research drop. And apart from that, also loading up on non-US stocks just to get a little bit more diversification in my portfolio.
Cool. So on this question, I mean, look, going back to what I said earlier, that we cannot predict the future. I mean, yes, we could be in the final last leg of the bull market, and things could absolutely reverse in a month. Or this could be 1998, for example, or 1997, and we might have 2 or 3 more years of this crazy bull market before things kind of really pop. Who knows? Honestly, who knows? And I would challenge the belief that you should buy every single dip because markets always, quote unquote, have to go up. Yes, buying the dip has worked well recently, but that doesn't necessarily mean it will always work. And there will be a time when it will fail miserably, essentially. You're going to keep on buying and buying, and then markets are going to keep on falling, and it's going to be like catching a falling knife. At the end of the day, like I said, you cannot predict the future. It's extremely hard to time markets as well. You cannot time the market top or the bottom for that matter. And I think the more sensible thing to do as an investor is A, to remain invested, and then B, to have a game plan. So if you are worried that, things are frothy or potentially in a bubble and things could burst, okay, remain invested, but have some ways to mitigate the impact. Your first and foremost, like your biggest defense and the only free lunch in investing is diversification, right? So do not go all in on the S&P 500, for example. Don't have your entire portfolio invested in an index that on paper, or shall I say by name, 500 companies is diversified, but actually, like I said earlier, literally a huge chunk of it, or like a third of it, is just in a handful of tech companies. So diversify across different stocks, different regions, different market capitalizations, but B, and perhaps more importantly, across different asset classes. Okay, so if the stock market were to take a big hit, you'll see bonds doing really well usually in that scenario. Gold could hold up well, and so on. So A, make sure you diversify. B, in terms of actually thinking about how to protect yourself from the stock market kind of collapsing, you can consider hedges. Okay, so you can consider buying, for example, put options on indices. We've touched on that a lot in our previous research. I also mentioned earlier about this concept of a trend filter. You can also apply a trend filter to your, S&P 500 ETF and so on as another way of protection. Trend filters will not, get you out at the absolute top. If markets roll over, you will take an initial hit initially, but then you'll sidestep and move into cash. And then if markets continue to tank, at least you don't, take that entire hit. And of course, when markets start to rebound, you will miss the initial rebound, but then you'll start to capture, hopefully, the next set of recovery. And for me, I'm happy and I'm fine to do that, to give up a little bit, here and there, but to avoid that really big 40, 50% market drawdowns, which can A, really devastate a portfolio, and B, really, get your emotional side out, and basically you end up selling at the worst possible moment after a big drawdown and then right before the markets kind of recover. So I would consider things like that. And then, finally, in terms of a game plan, have a game plan in terms of things you want to do after a potential market crash, if you think a market crash is coming. So what I discussed is how to protect you from a market crash. And then after that happens, and hopefully you've been well protected, you have some dry powder left. Okay, what are some amazing high quality stocks that you've always wanted to buy but are currently put off by valuations? Theodora has already touched on quite a few that she likes, high quality long-term compounders. I mentioned TJX companies. The only thing really I have against that stock is that valuation is kind of seems fair at the moment. But should it, for example, sell off because, everything is kind of tanking, I do expect it to outperform, let's say, the Nasdaq. Like I said, it's an anti-tech stock, but on an absolute basis, it could still go down 20%. For me, if I loved it at, let's say, $150, I'm going to love it even more at $120, right? And I'll probably buy more. So have a game plan in terms of how to protect yourself if you are worried that this is the last leg of the bull market. Again, don't try to time the market, remain invested. Try to find ways to diversify, implement some hedges, implement a trend filter to protect the stock allocation of your portfolio, and then have a game plan of what to do after a potential crash. Hey, what are some amazing companies I want to buy that are now suddenly trading a lot cheaper?
Yeah, so for me, the trigger is if there is a huge dramatic fall or change in the share price. So in the great wealth transfer basket, it's obviously kind of geared towards Bitcoin because we're looking at millennials and Gen Zers. They're not risk averse, right? They're the opposite. They chase risk. They like the new stuff. They're willing to experiment. So there was that allocation, I think probably of about 25% indirectly through Coinbase and Bitcoin as well. And then you've got Robinhood. And the portfolio hasn't done very well for precisely this reason. So the way I've constructed the portfolio is that it's a barbell. You've got 50% weighted towards the more stable end of the trend, which is an aging population. You've got death care stocks in there as well. And then the other half is like the risky portion of the barbell, which is the Bitcoin, the Robinhood, the Coinbase type of assets or stocks. And so I think the risky portion has really done badly. And that's because of Bitcoin majority kind of driving the downward trajectory. I think what's really interesting is whether you think the generational thesis has changed, whether you think younger investors are suddenly more conservative, are they abandoning crypto? So I don't see evidence of that. If anything, I think the appetite for digital assets and self-directed platforms remains strong. So I still like Charles Schwab. I still like Robinhood. The way I'll play this is maybe if you haven't bought into it yet, Bitcoin being down 40% could be seen as an interesting point of entry, but I wouldn't load up on it yet, right? Where I find interesting is actually in Robinhood, because if you question Bitcoin's role as a kind of payments method, or its identity as digital gold, and you don't think actually people might move on from it, I think Robinhood is interesting because it's also geared towards gamified investing. It's like the next big thing, and Russell recently wrote an insight on it, and I think Robinhood, they've done poorly because they're very exposed to Bitcoin, but yet at the same time they also benefit from the broader kind of behavioral shift towards gamified mobile first kind of self-directed investing. And that structural shift still looks intact to me. And then one last thing on the more stable side of the portfolio with REITs, I have got death care, listed private equity. Those plays are less about sentiment and more about demographics, which is a slow churn. Things happen, but they don't happen immediately. AI doesn't change the fact that trillions in assets are going to transfer hands. So if markets remain volatile, that actually strengthens the case for keeping the defensive end of the barbell intact. So what you could do is load up more in the defensive, and if you see a good opportunity, slowly start adding on the riskier side of the barbell, and you can tweak it. It's a barbell for that reason as well. The more defensive part is meant to offset the more volatile part. Yeah, so is now a good time to enter? I'll say selectively, yes, but with balance. The thesis hasn't broken. In fact, the volatility has actually created better entry points. I wouldn't load up purely on crypto, but I would definitely kind of build exposure across both ends of the barbell.
Yeah, first of all, what we mean by Goldilocks scenario, right? It's that, beautiful scenario. If you think about Goldilocks, right, and the porridge not being too cold or not being too hot. In this particular case, we're talking about the economy, right? So the economy is not, not too cool in the sense that, growth is still good, but it's not too hot where inflation is also soaring through the roof, right? It's that beautiful kind of in between ground. At the moment, inflation is cooling. It's still above the Fed's target, but it's heading in the right direction. Growth is okay. We had not so great numbers last quarter, but that was really mainly due to the government shutdown. So I would say we're almost kind of like in a Goldilocks scenario. But I think the bigger question to me is, not are we, or should I say the biggest risk is not, are we entering or are we going to leave a Goldilocks scenario, but more this thing that I've talked about in the past, which is specifically about the US economy and how it's gone K-shaped. So what I mean by a K-shaped economy, it's basically one where two groups of people are basically headed in the opposite directions, okay? So imagine the letter K, one arm rises, one arm goes down. So we're not just talking about inequality in a general sense, we're talking about, inequality that gets worse and worse over time, right? If you picture those arms in a K. And the US economy is arguably there. So actually, if you look at the data, so basically the richest 10% of Americans now account for around half of all US consumer spending. Now, this is super important because if you're not aware, US consumer spending in the US accounts for around 2/3 of economic output. So it's the main driver of the US economy. Now, the main driver of the US economy is heavily dependent on the richest 10% of Americans. So it makes things quite uneven and quite unstable. Now, on the other hand, the rest of Americans, a lot of them are really struggling. So, it can hardly keep up with basics. They're dealing with higher debt, higher interest rates on their debt, mediocre wage growth, you name it. And that's the big issue right now. Now, the richest Americans tend to be the ones that are heavily invested. So the reason they're, doing okay and really, still spending is that because of the wealth effect. So stock prices have gone up, house prices have gone up. They are genuinely richer, they feel richer, and on paper they are richer. Therefore, they end up spending, more and more. Now, the big problem or the big risk with this K-shaped economy is, well, first of all, growth becomes narrower. So you're leaning, more and more on a small subset of people. B, inflation dynamics get a little bit weird in the sense that, if companies can keep on increasing prices and they see, the rich Americans that keep on absorbing it, then they'll continue to keep prices elevated or continue to raise them. And that can cause inflation to be rather sticky. C, it's rather politically noisy, right? If you have this inequality and that's growing worse and worse over time. But D, and perhaps the biggest risk of all, is that it makes the economy more sensitive to asset prices. So like I said, if you think about the richest 10% of Americans, who now account for half of consumer spending, they are the ones that tend to be heavily invested in the stock market and houses and so on. A lot of their wealth is tied to asset prices. Now, if we have a big hit to the stock market, for example, what you will end up seeing happening is through the wealth effect. So a lot of these, rich Americans will see their wealth go down because again, they're heavily invested. Therefore, they are poorer on paper, they'll feel poorer, they start to spend less. And because they are the ones currently holding up consumer spending and therefore the US economy, you get this big, feedback loop between falling asset prices, the rich Americans cut back on spending, corporate profits go down as a result, stock prices go down even more, and then you get this kind of feedback loop. So that's something to kind of really bear in mind in terms of how we can actually go from an AI bubble burst and a stock market collapse to an actual recession in the US economy because of this K-shaped economy and because how much the economy is currently dependent on the spending of the richest 10% who are heavily invested in the stock market. Another thing also, like kind of related to this, is that if you have an AI bubble burst, well, currently right now, all this huge spending we're seeing on data centers and so on, that's actually really propelling US economic growth at the moment. It's becoming a really big driver, business investment. Again, if you have a bubble, bursting, and these hyperscalers cut back on investing in AI and in data centers, that'll be a very direct, hit to economic growth as well. So to me, that's something really to bear in mind. So to me, the key risk isn't, okay, we might be in a Goldilocks scenario, but are we about to leave the Goldilocks scenario? But it's really about thinking about this K-shaped US economy and what are the risks involved with that, as I kind of just discussed.
Great. So, yeah, on this trading 212 question, there are basically two ways you can buy a stock, right? On that platform. You can actually invest in the real share, which is, and if you do that, you're actually owning the stock, right? So if Nvidia goes up, you benefit. If it pays dividends, you get them, and you can hold it for years. Now, when you buy into a CFD, which is short for contract for difference, you don't legally own the stock. What you're doing is you're betting on whether the price goes up or down. It often involves leveraged, which is borrowed money, and then that can amplify your gains or your losses. There are also usually other fees involved, like overnight fees. Yeah, so the reason why one, sometimes they offer real shares in another CFD is usually just how the broker set things up. So if they're offering real shares, they require more paperwork. It's just, custody arrangements, there's more operational work involved. And so it's much easier sometimes to just choose to offer CFDs for certain stocks. How it impacts you is that if you're investing long-term, CFDs are usually riskier and more expensive to hold for the longer term because of all the fees I've just mentioned. So they're more like trading tools as opposed to investing tools. So if you want to invest properly and hold onto a stock for years, then I would say owning the real shares is actually the better option. Yeah, so when people actually ask about the future of Bitcoin and whether quantum computing could destroy it, I think the first thing to understand is what actually keeps Bitcoin secure today. So Bitcoin is protected by something called cryptography. And cryptography sounds like a very complicated word, but it's basically just a very advanced form of digital lock and key security. So imagine if you have a super complicated padlock that protects your money. Only the person with the right key can open it. And in Bitcoin, that key is a private digital code that lets you send your coins or do anything that you want. And the lock is built using very complex maths that today's computer cannot realistically break. Now, the fear is that quantum computing is this new type of computing that could, in theory, solve certain mathematical problems much faster than your usual computers that we have right now. And then some experts worry that if these quantum computing become powerful enough, they could then break the type of mathematical locks that I just mentioned that Bitcoin uses. So in simple terms, they could potentially guess someone's private key from their public information and steal funds. That sounds very scary, but the most important thing to bear in mind is that's a very long-dated what if, we're not there yet. And the kind of quantum computer needed to break Bitcoin security at scale doesn't currently exist. So it would definitely require machines that are far more powerful and far more stable than anything we have publicly available today. So even governments are still years and possibly decades away from having systems that can do this reliably. And so even if quantum computing actually becomes a real threat, right, we have to imagine, the possibility of that as investors. Bitcoin is not frozen in time, right? It is software ultimately, and software can be upgraded, just like your phone gets security upgrades. Bitcoin's network could adopt new quantum resistant forms of cryptography if needed. That process will require coordination, but it is technically possible. The bigger issue I have with Bitcoin is actually more about its identity and role. And so the real question for me, I think, is what is Bitcoin supposed to do, right? Some people see it as digital gold, the kind of like scarce asset that people hold longer term as protection against either inflation or financial instability. So if Bitcoin becomes widely accepted in that role, then the future depends more on trust, on regulation, on adoption by different institutions, than more on quantum computers. So what we have seen so far is that relationship with gold doesn't seem to hold. If anything, Bitcoin is seen as a risky asset. So people are risk off. The first thing that happens is Bitcoin goes down and gold goes up. So it's kind of the exact opposite from what it was meant to accomplish. So you can safely strike out that digital gold identity from Bitcoin for now. So as I've mentioned, people treat Bitcoin like a very high risk tech asset. I think it behaves more like speculative investment, and that's precisely how I've used it in my great wealth transfer portfolio. It's more speculative. When global markets are confident and if investors want more risk, then Bitcoins tend to rise sharply. And the same happens on the opposite. If people are nervous, worried about AI taking jobs, or if interest rates rise, then Bitcoin will often fall sharply, as Russell has mentioned in his portfolio. So the main driver of Bitcoin's future, just to sum it up, I don't think it's really a question of quantum computers. I think yes, but very, very far out. I think it's more whether Bitcoin can mature into a stable store of value. Can it compete with stable coins? Or whether it simply remains this volatile, sentiment-driven asset.
Okay, a lot of different sub-questions in this, so I'll try to just go over each one rather briefly. So on Bitcoin, I mean, Theodora actually said quite a lot, to be honest. I don't have that much to add. I think Bitcoin really has always tended to move in line with tech stocks. And now that the big institutional investors are invested in it, which, okay, could be good from, an adoption point of view, but also to me, that leads to more volatility because now institutional investors are not investing $1,000, $2,000 in Bitcoin. You're talking about millions and millions. So when, let's say, tech stocks are doing poorly and Bitcoin is doing poorly, and then these institutional investors who are very quick to cut risk and cut their losses, they start to sell. They sell big chunks of Bitcoin, and that leads to, this big feedback loop where Bitcoin falls even further because you have these big institutional investors selling. That triggers more institutional investors to sell and so on. So just the ownership makeup of Bitcoin at the moment is kind of leading to this, in my opinion, this kind of higher volatility. And like Theodora alluded to, so we had this, growing concern over the past few months about the debasement trade, or basically, is the US government gonna basically inflate away their debt and so on. Gold has really stolen the show. It has done really well as a hedge against that, but Bitcoin, that's often dubbed as digital gold, unfortunately didn't do well. And also, as Theodora mentioned, there's these growing risks about hacking with quantum computing and all that. So I've already touched on a lot of this, but once again, 3 layers of protection The easiest one, diversification, okay? Just make sure you diversify across different asset classes and looking at stocks specifically, diversify geographically by sector and so on. So honestly, diversification is the only free lunch in investing, and I really recommend you eat it. Second of all, hedges. So if you're worried about volatility, if you're worried about, a potential bear market, do consider hedges. So one kind of quick way or rule of thumb that I apply is by looking at the VIX index. So that basically shows you, it's called the fear gauge, right? But also what it really shows you is the implied volatility on the S&P 500. And you can read it as how costly it is to buy a put option on the S&P 500. So the higher the VIX, the more costly it is. So long-term average of the VIX is around 20. And for me, if the VIX is somewhere below 20, I would personally just buy outright some put options on the S&P 500 because it's relative to history, it's still a bit cheap to buy that protection. If VIX is much higher, then what you can do is basically what's called a bear put spread, which is basically when you buy a put option, but then you simultaneously sell a put option that has a strike price lower. So basically, because you're buying one put option and selling another, that volatility effect or the price of protection is almost kind of canceled, and you don't end up overpaying for that protection. Again, if you want to understand the details, we have a research drop on that, basically on how to implement put bear spreads. And then last but not least, you've got momentum filters. So again, these are rules-based, easy systems that you can implement to avoid, really getting riding like a big down market. And again, we have lots of research out on that. So look, CENTRUS, energy, uranium stock I highlighted in my nuclear research back in 2024 has done amazingly well, shot up, and I think some reversal is expected in light of that. And I think, let me actually just check here quickly. So when I wrote about this, it was around $80. Now it's at $200. So even though, yeah, it has come down, but let's not forget the bigger picture. It's still up massively. And high level, I do think valuation is still probably a bit elevated at the moment, but for me, as a long-term investment, I'm really happy to own it for the next 10 years, to be honest. It's, uniquely positioned as the only US firm that can enrich uranium. And it's uniquely positioned in such a structural growth story. So booming energy demand because of data centers, electric vehicles, electrification of heavy industries, a lot of focus on carbon emissions. Nuclear is very uniquely positioned as an energy source to meet that, especially considering nuclear, produces electricity 24/7 round the clock, which is what data centers need. Okay, data centers, you cannot have intermittent energy. You need 24/7 electricity. So I'm very happy to own that over the long term. Having said that, after its run up value, the stock is looking kind of expensive, and I'll happily admit that. But again, for me, it's a 10-year stock that I'm happy to own, so I don't mind this kind of short-term volatility. Bloom Energy is very interesting, and it's very funny that you mention that because I actually invested in Bloom Energy ages ago. I think like soon after IPO'd, and I lost money on it. I think it shot up and then it kind of like really collapsed, and I ended up selling and I gave up on it. But then actually I invested in it last year, and thankfully I've managed to make money on it so far. Now I've trimmed my position because again, it has shot up. Valuation is looking quite extended. But I think it's really interestingly and uniquely positioned to address what I've talked about before, which is one of the biggest bottlenecks in building data centers these days, which is energy. And again, data center companies are being told to procure their own energy, and Bloom Energy can actually do that. Okay, if people are not familiar with Bloom Energy, they manufacture and operate fuel cells. Fuel cells take natural gas, but you can do it with other like clean hydrogen and so on, but they take natural gas. They do not burn it, but it directly converts the natural gas into electricity. So it's a much, much cleaner process than running the natural gas through a turbine and generating electricity that way. And the cool thing is that you can build these fuel cells directly next to a data center and supply electricity to a data center that way. So they are actually already benefiting from the data center boom. They have a partnership with several utility companies and an infrastructure company to be like the preferred partner when they go to data centers and when data centers come to these utilities to procure energy. So they are already benefiting from the data center boom, but I'll just watch out for valuations. It is again looking a bit expensive. If you are investing some cash that you need in 6 or 12 months, honestly, that should really dent your ability to take risk with that particular pot of money. So if you need that money in 6 months or 12 months, you should not be, putting that money, not even in stocks, in my opinion. I think for something you need on such a short-term basis, I would honestly really recommend something like a attractive money market fund or a very short-term bond fund. So a bond fund invested in bonds that kind of fit that maturity you're talking about. So bonds with a maturity of under 1 year. So basically a short-term bond ETF is what I'm trying to say. Because the last thing you want to do is, put that in stocks and then, let's say later this year, we get a big stock market crash. You lose half of that money that you needed to, I don't know, maybe you're buying a house or something like that. So honestly, don't gamble with that money. Don't take any risk with that money. Just put it in a money market fund, put it in a bond fund, especially if you need that money within the next year. That is a wrap of our wrap up. So thank you everyone for tuning in. Hopefully that was helpful. And we'll see you next month. And as always, if you have any questions, please feel free to shoot them our way and we will be more than happy to answer them.
Thanks, Reda.
All right. Ciao, guys.
Thank you so much, everyone.